can tell you one thing, you can never become rich unless you're a disciplined person. Same money, 1 lakh, if you had put it in ELSS for 15 years, you take out the money on 18th year, the corpus will be 1 crore, 3 times more. What more you want? Today everybody talks about retiring at 45 years. I don't see any reason why they cannot retire.
Hi everyone, welcome to Moneyskills by Scripbox. I'm Velkarthik Anand, and today we're going to discuss about how mutual funds is a powerful tool in wealth creation. Joining me today is Mr. A.K. Narayan, who's a chartered accountant and a capital market specialist with 3 decades of experience. He's also an author of the book How to Invest Right and Prosper. So thank you for joining me today.
Thanks for inviting me.
Sure. So I've been meaning to ask you, there's a lot of talk about mutual funds nowadays, and I just wanted to check with you, what is it all about?
See, the mutual funds advertisements have really caught the eyes of investors today in India. If you look back, the investments were mainly into bank deposits, post office deposits, and recurring deposits, and so on. The visibility of mutual funds and stock market was very, very few people indulging into these things. But today, thanks to our regulator, AMFI, AMCs, and distributors' efforts, we are seeing a lot more activity in the mutual fund area. And so people are also curious to know what is it all about. So we are seeing investors like to invest in a mutual fund in a small way or big way, and then talking about investing.
How did you get into this field, like advising customers, advising clients who come to you?
Basically, I started my career, like I said, after chartered accountancy. I worked for corporates. And at that time, I started deploying my savings into equity market. And I felt that equity market is the way forward. So after working for almost 25 years in corporate, I thought I must start my own distribution house. In 2003, way back, I started my own distribution of mutual fund house. I thought it will be a little easier for me to manage it because it will not be like a stressful job like a corporate. But to my surprise, many investors started coming in, and a lot of people wanted to have correct advice, how to deploy their money, where to put their money, how much to put money. All these questions keep coming from them. So that helped me to bring about an awareness among the investing public as well as my investors as well. So I was very happy, and in the bargain, I also gained a lot of knowledge. And I must always say, if you want to be successful in equity investing, you need to be knowledgeable, you need to attend programs on a regular basis, and you must spend time with your family in evaluating the performance of your funds. You cannot do it all alone. I have seen many people coming with the entire family for my investor awareness meeting to understand how it works and where the money is deployed and how much return they are getting. So the key here is the family should be involved while planning your finances. So to that extent, I'm very, very happy that the financial goals I could meet because of equity.
So what would you say were like the main benefits in investing in mutual fund as opposed to direct equity, which you were doing before?
See, the direct equity investors, by and large, come back to me and say they invested in a wrong stock. They picked up a stock hearing somebody recommending, and ultimately, the company gone for a toss. And many people have lost money during Harshad Mehta scam or Ketan Parekh scam and many other things. So to overcome this, for a beginner or for a person who want to create wealth, my recommendation is to put money in a mutual fund product. If you really want to know the real differences, say you want to start learning swimming, which is better, whether to go to a hotel swimming pool or to go to an ocean, Indian Ocean or Arabian Sea, which is better and which is safer? I would think getting started in a swimming in a hotel is much superior because the safety aspects are there and you will learn the trick of the trade, and ultimately you can graduate yourself one day or other and go to ocean one day. So the stocks are like ocean and mutual funds are hotel swimming pools where you will get the benefit, but still the risk is little bit mitigated.
So you're saying that the mutual funds might be a safer option compared to equity in this case. But there are also 4,000 plus mutual funds to invest in. So, how do you pick the right mutual fund?
So there is nothing like a risk-free investments
Hmm.
anywhere. When you start putting money, any product, risk is always there. One should be aware of that. We are trying to talk to investors who are regularly putting money in fixed deposits in bank and post office. Why do they put it? Because the predictability of the returns and safety of the principal. So we are now trying to tell them the mutual funds are little better in terms of returns. So when we say that, we also have to add there is a limit of risk while investing there. However, we need to be very cautious while choosing the product. When you said 4,000 options are available for investing, one has to consult a person, an advisor, and then take his advice or her advice and then start investing so that your journey will be very smooth, fruitful, and ultimately you'll be able to achieve your investment goals.
Hmm.
But if you are going to graduate directly into risk prone mutual funds on your own, then the risk is also very, very high. I have come across many investors after burning their finger by going direct into equity. They will say that we can multiply our investments in a short period of time. And sometimes they also come back to me and say, I have identified a stock based on some hearsay, and after 2 3 months, they'll say that they have lost the money. The second mistake, what people are doing is they want higher rate of return each time they want to invest. It is not a question of becoming rich overnight. Equity as an asset class is good to beat the inflation, but you can never become rich overnight. So we need to take steps slowly but steadily in a disciplined way. So, two important virtues of investments are looking at long term and patience. If you are having enough and more patience, nobody can stop you from becoming rich. I can assure you, based on my own personal experience and what I have done in the last 30 years. But if you want to be very fast and get into wrong products, then you are in trouble. So, selection of the product is very crucial. And also keep in mind that you must not aim for too high a return, and a decent return is what I'm talking about.
So, realistically, what are the returns you can expect in a mutual fund, not only in the short term, but in the long run as well?
We need to have 2 3 buckets. The mutual fund per se can be considered converted into 3 different buckets. One is a debt product, one is a hybrid product, and a third is an equity product. A debt product is something similar to fixed deposits, but it has got its own risk. So if your term time frame is about 3 to 5 years, 6 years, you can put it in a debt product, no problem in that. Or if your time frame is very short, you can put it in a liquid fund. So you may get about 5 6% in a debt fund. That kind of expectation you can get into that debt products. In hybrid product, if your time frame is 4 to 6 years, you can look at it. You can get about 7 to 8% return. And if you are ready for investing for a long goal beyond 5 years, if you don't need the money for beyond 5 years, definitely you should go for equity product, and that can give you 12%, which can beat the inflation. So in this current scenario in India or elsewhere, when the interest rates are likely to fall, you need to protect your capital and you need to create wealth by beating the inflation related expectation. So my recommendation is equity should be a component of your portfolio all the time. Without equity, you cannot create wealth.
How do you invest in mutual funds to meet multiple goals at the same time? Like you could be investing to save for your children's education, like you said, for traveling, for retirement. So, how do you go about that?
See, when you start your career, 30% of your income should go into saving. A lot of questions come about whether it is a net salary or a gross salary. That is the starting point they ask me. I always say gross salary should be kept in mind. I don't know what are all the deductions you're going to have. So I say 30%. A person getting 1 lakh, 30,000 rupees should be your minimum saving. In that minimum saving, you allocate towards various heads, whether it is for your marriage or children education or buying a property or retirement or your travel, small amount. And don't touch that money unless it is for that particular purpose. For example, I start saving 2000 rupees for retirement planning. I must not touch that money till I retire. That should be your perseverance to invest. I can tell you one thing, you can never become rich unless you're a disciplined person. That's why I said in the beginning, financial habits will not come automatically to everybody. You need to spend some time into it, compromise a little. What is compromising? Not buying anything and everything which you can afford or you cannot afford. You need to be careful, cautious while spending money. So, spending money very carefully is a starting point for saving money and investing money. Many people think that budgeting is not of great help, but I will disagree with them. You must have a budget for anything and everything. And if you are going to have a correct budget, and if you're going to invest accordingly, and you want to achieve a particular goal, I can tell you that you can retire early. Today, everybody talks about retiring at 45 years. I don't see any reason why they cannot retire, provided they follow the financial jurisprudence. They have to be extraordinarily careful about it. But many times we find that people are thinking that making money is easy and they can double their money quickly and get into Ponzi schemes which are unregulated. That is why I'm saying regulated schemes are far more important than unregulated schemes. You should not lose any money.
Understood. So you also mentioned that you shouldn't be touching the money that you're investing. But in case there's an emergency, are there any implications on withdrawing the money from your mutual fund investments?
See, what I would think is emergency fund is a must for you. You create an emergency fund which is maybe equivalent of 5 6 months of your expenses. Suppose I'm spending 30,000 rupees a month on a monthly expense. Keep 1.5 lakhs or 2 lakhs as an emergency fund in a FD or liquid fund and don't touch it unless you want emergency. But in the name of emergency, don't dismantle your long term financial goal money lying there for retirement or house building or long term travel or whatever expenses. You should not touch it. So, you must have the discipline of using emergency fund for only emergency, and these goals have to be kept in mind all the time.
So you had mentioned earlier that systematic investment plans are very important for maintaining a good financial habit, right? Could you elaborate on that? Why do you say so?
Systematic investment plan are very popular for two reasons. One, most of the investors are earning money month on month. So very few are able to have bigger money now and then. So this salary or any credits they get on a month to month basis makes them easy to invest money in a systematic way in any of the equity related mutual funds. The idea behind this is when you invest money on a regular basis in a disciplined way, especially out of your own savings, the value of investments keep growing because of power of compounding. The power of compounding works in a way that helps an investor, whether the market is up or low, it creates a value for him over a period of 10 years or 12 years. I have seen in the past a small amount of 5,000 rupees put by a young boy or a girl of 25 years getting almost a crore of rupees when they attain 55 years of age. So, if you want to achieve 1 crore or 2 crores, it is very easy today. I have seen people having a corpus of 1 crore and 2 crores at the age of 45 or 50 years because they were very disciplined and they started contributing towards equity products from a young age without any interruption. A lot of questions come about. What will happen in the case of market correction? You should not time the market. You should only be a disciplined investor and keep on investing and leave the rest to the professionals to manage your money. The money management will be taken care of by them, and all you need to do is to deploy your money on a regular basis. So, to answer to your question, SIP is the best way to go forward and keep on adding your money, and you can top up SIPs year on year. Whenever you get your increment, you can top it up by 5% or 10% whenever it's convenient to you.
So investing early is the key message that is coming across. So would you say that even if you delay by say a couple of years in terms of starting your SIP, would that have a detrimental impact in what your final corpus is?
Definitely, it will be there. When I say 25 years to 55 years, if you're going to get a 1 crore, on the other hand, if somebody starts at 35 years, this 1 crore will not be the figure at the age of 55 because it will be falling short by 30 lakhs or 35 lakhs. So, there is a major difference between starting early and investing regularly and putting the same amount on a long term basis.
So mutual funds are here to stay. So how would you compare them to say recurring deposits and the interest regime currently?
See, when people were earning less, people did not have options. People are putting money in interest bearing instruments like fixed deposit, recurring deposits, post office deposit. I'll tell you an example and the history of interest. In 1989, when I went for investments into corporate deposits, it was giving me 16% per annum as interest. So I thought 16% is quite a good rate of return. So I was putting my money there. In 1999, when I went, the same company was offering me 13% as interest rate. In 2009, when I went there, it has become 10%. And now, in 2019, it has become 7%. It is all related to the inflation. So, when it has come to 7% in 2019, I feel in 2029, the rate can be 4% or 5%. I may be wrong, but the history tells me every decade you are losing 3%. So, why should one go back to recurring deposit today when your SIP investments are fetching higher rate of return and predictable return more or less on a long term basis and a well regulated product as well?
What are your thoughts on people investing in mutual funds based on past returns?
It's always a question, very difficult to tackle this question also. Many people who come to my office, they say, sir, last year this particular fund, small cap, has delivered 60% return. Mid cap has delivered me 52% return. So when I try to explain to them, sir, don't put all the money like this in a small cap or mid cap because the valuations are stretched and you cannot go by the past returns. SEBI repeatedly says investing in equity is risky as well. Don't look at the past returns because past returns are not guaranteed. So, but still, investors always have in mind that returns are important. So, my recommendation is don't look at the past returns, keep last 10 years, 15 years return as the basis, and keep a reasonable rate of expectation built into your system before investing money. So, my own feeling is 12-13% rate of return on a longer duration should be your expectation.
So is that how you would say is the right way to evaluate the performance of a mutual fund?
I would think 12 to 13% if you're able to get on a regular basis, on a consistent basis, I think you have done a great job over a period of time. But if your expectation is 25 and if you get 20%, you will get disappointment and you will say that the funds are not performing. Today, somebody called me from UK and says, sir, I am assuming 20% is the return. The next 10 years, I want to come to India and retire. Will you be able to help me? I said, 20%, how can I even take it to account for evaluation purposes? I cannot do it. After 2-3 calls, can you believe it? That man stopped calling now because he must have found somebody and he must be investing based on 20% rate of return. So I don't think we should look at 20% and build into the system and then look at your projections. It's a very wrong way to do.
So we've heard the importance of investing in the equity asset class of the mutual fund. Could you touch upon like why someone should invest in debt, ELSS, or other asset classes like liquid?
See, liquid fund is a great way to look at it. Yesterday or day before, I remember one gentleman came and said he has sold his old car. And he said, 5 lakhs of rupees I have got, sir, now. I have not decided what car to purchase again. So I said, why don't you put the money in a liquid fund and wait for a month or 15 days? Whenever you take a decision, you can deploy this money there. He didn't understand it. So I explained to him the liquid fund is a temporary place where you can park your money and money is made available to you at 24-hour notice, and it also gives you a return of 5% or 5.5%. Of course, it is not tax free, but you can park your money regularly. The second thing I explained to him, Parking the money in a savings bank account will fetch you 2.5%, 3% rate of interest, whereas you are able to double your money by 5% here. So why not you put your extra money available in savings bank account in a liquid fund which can give you 5% on a regular basis, and it serves your purpose. So my view is each and every investor should have a liquid fund in their portfolio, or maybe in case time is there for 3 months or 6 months, you can even look at arbitrage or any other fund where the risk is very negligible and you must deploy your money. So starting point can be liquid, and you can scale your investments over a period of time. I'll give you another example. I have an investor who always doubting the Sensex movements, and they always expecting a crash in the market. They are educated and they work for a software company. Two of them used to come and meet me, husband and wife. 3 years ago, when they came and met me, they said, market is little unstable, sir. So I was just wanting to see when I can invest. I said, market will be like this only. You start your investment right away, whether it's SIP or lump sum. They said it'll come back to me. They never came. Again, they came back after 1 year. They asked me similar questions. My answers were more or less same. And again, they went back. Then again, the third year they came. The best part is the questions were same, my answers were same. And this time I said, since you are having a doubt about the market movement, I recommend you put money in liquid fund and you will not have any loss of capital at all. So they started investing money, 40 lakhs or 50 lakhs each, and they put the liquid fund. Then after that, 2 months they came back and said, sir, this money has grown a little bit now. 40 has become little better, sir. I thought market corrections will happen and it will also take away. So they're very happy. Then I told them, use systematic transfer plan and start putting money in equity. So now you'll be surprised. They have started using STP. Small money is going regularly and they are quite happy about it. So liquid fund serves the purpose for many people. So whenever I find investors who are having doubtfulness about the market, the starting point should be liquid.
And what would you say about ELSS?
ELS is a great tool for investing for saving the taxes. You can invest up to 1.5 lakhs every year, and it has got a 3-year lock-in period, and it delivers. It's an equity scheme, so automatically you get 12 to 13% or 15%. So a lot of investors ask me which is better, sir, PPF or ELSS. I only tell them if you have only 1.5 lakhs, you can probably bifurcate 75,000 rupees into PPF and 75,000 rupees into ELSS for your own comfort. But if you have more money, put maximum in ELSS. Why do I say so? If I look back last 15 years, if you're going to put money in PPF, it's a great product. Interest are tax free. 1 lakh you put every year in PPF, 15th year you would have put 15 lakhs. You take the money out 18th year or 19th year, you'll get about 32 lakhs or 31 lakhs based on various interest regime. Same money, 1 lakh, if you had put it in ELSS for 15 years, you take out the money on 18th year, the corpus will be 1 crore, 3 times more. What more you want, as an example, to see and enjoy the wealth creation without any effort, deploying only the limited resources. So there are innumerable examples I have where equity has delivered and satisfied the customers.
So investing in the equity asset class seems to be the way to create wealth. So what is debt? So what is the purpose of investing in a debt fund?
See, always we say you can't put all eggs in one basket. I have 100 rupees. I can't put all the money in equity and say I'm a brave man. I want to create wealth over a longer duration. So I need to have an asset allocation in place. Some money may be required in the next 1 year, 2 year, or 3 year. Put the money in a debt. Some money may be required between 3 years and 5 years. Put it in a hybrid fund. And some money which is not required, put it in a equity fund. But debt serves the purpose for your security and predictability of return, more or less, and also it'll give you a peace of mind that monies and principles are always safe irrespective of what happens, because our temperament and the liquidity position always keep changing, and one should not feel bad that the market corrects sometimes. So debt is a great product to look at, which unfortunately people are not very aware of.
Could you share some success stories of clients who you helped achieve financial freedom?
Yes, many people have come to me for investing, either youngsters or middle age group or people who are about to retire. All the three categories of successful people are there with me. I would think that youngsters are very happy when they're able to deploy their money and see their wealth growing. Middle aged people, they are very happy because they're able to achieve certain goals and they're able to use the money for achieving the goal. Recently, one person called me from USA and said, for the last 20 years, I've been investing. He wants to renovate his house and do up a house in a big way. He was surprised that money was there in a big way in his corpus and he could use that money for renovating his house. So, likewise, people who are about to retire, I always tell them use the SWP route, systematic withdrawal plan route, rather than deploying all the money in fixed deposit and look for a rate of return from interest. That may not be a great idea. I have got a lot of people who have retired also, who have deployed and using SWP route, and they are quite very happy because not only the capital has grown, their corpus has grown, but they are able to get predictable return on month like a pension.
That brings us to the end of the episode. Thank you, sir, for joining us and shedding light on how mutual funds can be a powerful tool in creating wealth.
Thank you very much.
Thank you.